This spreadsheet presentation shows the financial analysis leading to the lease versus buy decision. I'm Pat Obi, Professor of Finance at Purdue University, Calumet. In a leasing contract, the lessee is the party wishing to borrow the equipment, as shown in this illustration. The lessor is the lending party, so the equipment will transfer from the lessor to the lessee. For the lessee, this is a financing decision. Obviously, in a previous capital budgeting analysis, the lessee must have determined that investing in the equipment will add value to the firm. In other words, the equipment has a positive net present value. The question now is, which means of financing it is cheaper? Is it cheaper to take out a loan and pay interest charges and then use that money to buy the equipment, or is it cheaper to lease the equipment? Now, as we can already see, leasing is an alternative to borrowing money and then buying the equipment. Because if you borrow, you pay interest charges. If you lease, you make lease payments. Both contracts require a fixed term, and also both contracts call for fixed payments, interest in the case of a loan and lease payments in the case of a leasing contract. And for good measure, both financing expenses are tax deductible. In other words, the interest charges you pay on a loan are tax deductible as well. The lease payments you make on a lease are also tax deductible. And so for this reason, the after-tax cost of debt is the appropriate discount rate to use in determining the net present value cost of each of the two financing methods, as we're going to show shortly. Now, the lessor is in the business of leasing out equipment to individuals and businesses wishing to rent them. As such, for the lessor, the financial analysis here is an investment decision. The lessor will be willing to lease out this equipment to any individuals or businesses that is interested, insofar as doing so will result in a positive net present value. And so, for good measure, the lessor's investment analysis is included in this spreadsheet presentation. In this example, the underlying equipment has a cost of $2.5 million, as I show right here. And the $2.5 million is also the depreciable cost. Depreciation will be based on the modified accelerated cost recovery system for the 3-year investment class. However, the equipment will be used for 4 years by the lessee. Tax rate here is 40%, and the weighted average cost of capital, which we're going to use to discount cash flows for the lessor, is 10%. At the end of 4 years, the projected market value of this equipment is $450,000. Now then, for the lessee, the financing decision is two-pronged: borrow money and buy the equipment, or lease it. If the lessee chooses to borrow, then the entire $2.5 million would have to be borrowed from a lending institution at a cost of 12%, as shown here. The after-tax cost, if you look up here, this is equal to, I hit equal, I click on this interest rate multiplied by 1 minus t, 1 minus the tax rate. I scroll up a little bit, and that's the tax rate, close parenthesis. So that's how you get 7.2%. Again, the loan term is going to be for the 4-year of use. And at the end of 4 years, the projected salvage value is going to be $450,000. So this salvage value is the same as the projected market value. Now though, maintenance expenses that will have to be made by this individual or this business would be $175,000 every year. However, this money, as I show here, will be paid at the beginning of each year in this example. Now, next up is the lease option. The lease would also be equal to the use term of 4 years. And the lease payment determined in this contract that is being offered is $600,000. However, there will be 5 payments to be made of $600,000 in a 4-year period. In other words, if you take out this lease, you'd make the first payment right away. And then at the end of the year, you make the second payment, and every year you make the subsequent payments. There are no other expenses, and the lessee does not intend to buy out this equipment at the end of 4 years. In other words, at the end of 4 years, the lessee intends to return the equipment to the lessor. It doesn't have any intention of continuing to use it. Maintenance expenses to be paid as part of a lease agreement is $85,000 every year. However, the money will be paid at the beginning of each year. Keep in mind, there's not going to be 5 payments of $85,000, as is the case with the lease. So we want to be very careful in identifying the specific information regarding this transaction. And of course, the projected residual value at the end of the lease term is also the same as the salvage value or market value, if you like, of $450,000. In designing this spreadsheet, I am careful to distinguish between the input data in the borrow option as well as in the lease option that refer to the general information. So input data in here that refer to the general information, you can see they're all in black, like the loan amounts B20. If I hit F2, it refers to the cost of the equipment. As well, you can see that the after-tax cost of debt is a calculated cell. So anything that you see here in black refers to the general input data. If it is in red, that reminds me that these are original data entries. So like all of these, as opposed to this. Alright, so now let's rock and roll. First set, depreciation. We have to show the depreciation expenses for each of the years. Using the makers method, these are the given recovery rates right here, based on the US tax code. And so all we do is multiply each of these rates by the depreciable cost, which is what you see here, 2.5 million, to get these values. And these are the running balances showing full depreciation in the 4th year. Next up would be loan amortization. The most important aspects here are the annual interest payments and the principal repayments. However, before we can get those, we first of all have to calculate the annual payments that will be made. Because the loan is amortized, payments are going to be the same each year for the 4-year period. So to calculate the amortized payment, I sit there and I use the PMT function for payment, open parenthesis. It prompts me for the rate, and for the rates I'm going to go up here and I click on the interest rate on the loan and I hit comma. I scroll down, it prompts me for number of periods. For number of periods, I go up here and click 4, comma. I scroll down to see what I'm doing. Finally, it prompts me for present value, which is the loan amount. It's always wise to reference present value figures with a negative. So I'm going to type negative. That way, my calculated results will come out positive. So I hit negative, and then I go up here and I click on the loan amount. And then I close parentheses because these additional input here are optional. They do not apply. Alright, future value, there is no future value here, and the loan is an ordinary. The payments are going to be ordinary annuities, meaning payments made at the end of the period. So we close parentheses and hit enter, and that's precisely what I have right here. And if you don't like the decimal showing on your spreadsheet, then kill it like so. Alright, and then keep in mind, this is the interest due for the period. Interest due for the period would be, I hit delete, equal the interest rate here of 12% multiplied, hitting the asterisk sign, multiplied by the beginning balance of the loan. Alright, that's what you see right there. And principal repayment is going to be, delete that, equal to the total payment made minus the interest component of the total payment. Alright, and that's how you get that. And finally, the loan principal would be equal to the beginning balance of 2.5 million minus the principal repayment for the period. All right, and the bid goes on for the entire 4-year period. And now the core of this analysis uh, begin with begins with the lessee's financing analysis. So again, we're told that maintenance payments will be made at the beginning of each year. So we line them up, all right, beginning from time 0. Interest payments, though, all right, typically in any pro forma income statement should apply quite naturally at the end of each period. So these interest payments are exactly these figures, all right? They are referenced carefully, ever so carefully. And then depreciation expenses that you see here, also showing them in their appropriate years, they come from this column of data right there. So now, in referencing these values, notice I reference them as negatives because this is a financing decision analysis and I want to use negative to indicate cash outflow. So now I add them all up and you see them here. All right. So after I add them all up, I then determine the tax effect. For all purposes, it's always good to reference the tax rate cell as a negative because tax is what you pay. So that if, as in this case, I use a negative and I reference my tax rate cell, which is this cell right here, and I hit times, which is the asterisk key, I'm scrolling down, and I multiply it by this value, the result is going to be positive, and rightfully so, because if you have a negative operating income, then the tax effect would be a tax savings. So these are all tax savings associated with these cash outflows. Now, if in a regular income statement analysis where this is a positive operating income, obviously when you use a negative to reference the tax rate cell and you multiply that by a positive operating income, then you'll get a negative result, which tells you that that's how much tax that you should pay. So again, negatives refer to cash outflows and positives refer to cash inflows. In this case, tax savings. And then you sum the two to find your net income. All right, so the net income is simply, I use the sum command. If you can look at it up here. All right, you don't want to go this cell minus this cell, you'll miss it. All right, so you use equal SUM because summing will net the two in terms of their different signs. Now then, we add back depreciation, as you see right here, because depreciation is a non-cash charge. Also, make sure you indicate your loan repayments because these values right here, these cash flows have to be paid back. But we were careful not to include this line prior to determining the tax effect because loan repayment values are not tax deductible. So we place them after the fact. And then this guy here, this is really a wash. You don't have to include the loan value and the cost of the equipment. All right, loan value means you borrow money, that's cash inflow. Cost of assets, you pay the money to buy the assets, so that's a wash. So whether or not you place this here doesn't really matter, but I leave it there anyways for good measure. At the end of 4 years, you're going to sell the equipment, and because you only plan to use it for 4 years. If you sell it, then the question is, would you have to pay taxes? And the answer is yes. You'll pay tax of $180,000. How would we figure that out? Keep in mind that your tax payment is equal to the tax rate multiplied by the market value of the equipment minus the book value. And in this case, if I go up here, you'll see that market value, which is 450, is greater than the book value in the 4th year, right here. See, because in the 4th year, this equipment would have been fully depreciated. So you'd have to pay taxes equal to 40% multiplied by the entire $450,000. And that's it right here, $180,000. So then, we then sum all of these. So in summing, if I hit F2, you're summing from your net income down. Right? If I place it here, F2 again, you're summing from net income down because your summation would have to account for the added for the depreciation that's added back, the principal repayments that you'd have to make, and then the money you'd get from the sale of the machine, and then the tax you'd pay on this, so to speak, profits in the sale of the machine. So with that, we use the NPV function, as you see up here, to calculate the net present value of the cost of borrowing money to buy the equipment, making sure we discount using the after-tax cost of debt. You do not use the interest rate on debt. You do not use the weighted average cost of capital. You'd have to use the after-tax cost of debt. The reason being, again, that these cash flows are tax deductible for the most part. All right, so to use the NPV function, it's equal NPV, you open parenthesis, it prompts you for the rate. So for the rate, when you scroll up here, you carefully click on the after-tax cost of debt. Coming down here, comma, then it says values beginning from the first to the last one. So this is the first because it's in the first year. Click, hold all the way to the end, and you close, and then you subtract the initial cash flow. But don't be quick to write minus this cell, because this cell right here at time 0 is a negative cash flow. If you leave this negative here, it's going to actually add it in. So we don't want to use negative to indicate subtraction. We want to use positive so that our mathematics will be intact. So we hit enter, and that's it. It says if you borrow money to buy this equipment, the net present value of the cost of doing so is about $1.8 million. Now, on the other hand, if you choose to lease this equipment, if you were the lessor, notice you'd have to make lease payments beginning with $600,000 now, and then $600,000 at the end of each of the subsequent years. Also, if you go up here, you'll see that this funny lease deal here calls for the lessee to also make $85,000 every year in maintenance payments. So it's probably like a maintenance contract that's purchased alongside with the lease, so that every year the lessor gets to make these payments, and the payments are made at the beginning of each year. So it's like an annuity due. So then you add them all up, and then you determine the tax effects, as I already showed, making sure to reference your tax rate cell with a negative, as you see right there. All right, and buyout option, no. All right, so I use an if statement, if you like. It kind of makes it more global, which is that if this cell here says no, then there's not going to be a buyout option, in which case put a negative, put a 0 right there. Because if there was going to be a buyout option, then the cost of the equipment, let's go back here, 4 years from now would appear there. So for example, if I come up here, I kind of made this to look a little bit of a fancy. If I type in yes there, and I scroll down here, where are we? There you go. You'll see the $450,000 is a negative cash flow, because it means that at the end of 4 years, the lessee would have to pay $450,000 to purchase this equipment. And of course, if you go back here in the buy option, you'll see that the sale of the machine would no longer apply, because if you buy this equipment, if you borrow money to buy this equipment, that means you intend to keep using it beyond the 4-year period. So at the end of 4 years, you still continue to use it. You're not going to be selling it and dealing with tax issues. So it's either you use the equipment for 4 years or you don't. If you plan to use it for only 4 years and you borrow to buy it, then 4 years from now you'd have to sell it. So undo, 4 years from now, that's it right here, you'd have to sell it and get that money and pay the tax. But that also means that if you were to lease it, then at the end of 4 years you'd have to return the equipment to the lessor and not have to deal with any additional cash outflow at that period. So with that, we find the NPV of the cost of the lease, and that comes out to be $1.76 million approximately. And as you can see, the cost of leasing is cheaper than the cost of borrowing money to buy the equipment by $42,799. This positive difference here is referred to as the net advantage to leasing. So as a result, the if statement I used here says to lease the equipment if in fact you have a positive net advantage to leasing, which is the same thing as saying if the cost of leasing is less than the cost of buying, because leasing is cheaper. The question therefore becomes, well, what is the break-even lease payment? In other words, what lease payment would make the lessee indifferent between taking out a loan and buying this equipment versus leasing the equipment? For that, we use the goal seek command under data. What if, depending on the version of Excel you use, just look for the goal seek command. So goal seek. So we want the difference, the net advantage to leasing, to be equal to 0. By changing, we go up here, the lease payment. So we change the lease payment. Okay. So as you can see, it's $616,316. Based on this lease payment here, there will be no difference. Again, remember, cost of buying is 1.8 million, and that would also be equal to the cost of leasing. So if break-even payment is if lease payment is 616,316, we're going to be indifferent. For any lease payment less than this amount, leasing would come out better. Above this amount, leasing will not come out better. For example, if I go up here and I change this to, let's say, 620,000, which is higher, 620,000. As you can see, going down here, the net advantage to leasing has turned negative, because now the cost of leasing is higher than the cost of borrowing money to buy the equipment. Alright, so let's undo, and let's undo once again, restoring the original data set, where, as you can see here, lease payment is $600,000. So this actually concludes the lease-buy analysis for the lessee. Now, for good measure, we have included the lessor's investment decision analysis, whereby the lessor gets to receive $600,000 beginning with now and then each year for the next 4 years. Also, the lessor owning the equipment would have to depreciate this equipment, and these are the depreciation expenses. Sometimes some students get a little confused and say, well, why would you want to recognize depreciation expenses for the lessor and also do so for the lessee down up here? But don't forget, this depreciation expenses are recognized under the lessee's buy option. In other words, if the lessee were to borrow money to buy it, then depreciation expenses would apply. But if the lessee were to choose to lease the equipment, then notice there are not going to be any depreciation expenses. The equipment belonging to the lessor would make the lessor the beneficiary of the depreciation expenses, unless it is a type of capital lease or any kind of micro arrangements whereby that's not the case. But otherwise, the lessor's in the lessor's analysis, that's where you recognize the depreciation expenses. There will not be any maintenance expenses paid by the lessor, and I put a little asterisk here to remind you that the lessee pays maintenance expenses. If I scroll up here, you will see that under the lease option for the lessee, see there, maintenance expenses. So it does not apply in the case of the lessor. And then you recognize the tax effects, and of course, being an investment decision, you can expect money to be made in most of the cases if it is going to be a good project. And then we add back depreciation right there. And don't forget, at time 0, the cost of the equipment. Obviously, the lessor paid money to purchase the equipment in the first hand and then subsequently lease it out to the lessee. Now, at the end of 4 years, the lessee returns the equipment, which the lessor can sell for $450,000 net of taxes. Now, you might wonder, but what if the lessee chooses to keep the equipment over here, if the lessee chooses to keep the equipment and then pay the $450,000, still the lessor will get that money. So whether or not the lessee keeps the equipment doesn't really matter. In fact, it doesn't matter. In the lessor's analysis, you still want to recognize the fact that the lessor is going to be hanging on to an equipment worth $450,000, which the lessor can sell either in the open market or sell it to the lessee if the lessee is interested for that amount. At least that's the projection. With all of that, we sum the net cash flows. If I hit F2, again, it begins from net income, because if I go down here, you kind of see it a little bit more for what it means. It's the net income plus depreciation, which is added back. They are cash to be received from the sale of the equipment and the taxes to be paid on the difference between market value and book value. Then we calculate NPV. For IRR, it comes out to be 10.4%. The IRR function, IRR, says get all the values. It doesn't say from the first. So for this, we're just going to have to grab all of these, close parenthesis, and that's it right there. You can expand it to kind of see that it is indeed 10.4%. So the NPV is positive. The IRR of 10.4%, as you can see, if I go up here, is greater than the cost of capital of 10%. So since the NPV is, let's go back down here. Since the NPV is positive, we accept the project. All right, the lease should be carried out since NPV is positive. Now, as it turns out, the break-even lease payment for the lessor is $592,885, which again we can find by going to Data, What If, Goal Seek. We want to set the NPV to a value of 0 because the NPV is the yardstick with which the lessor will determine whether to go ahead with the lease or not. And then by changing, we go up here, the lease payment, and OK, and OK. So that's $592,885. So as you can see, at that lease payment, NPV is 0. And so for any lease payment above $592,885, NPV will be positive. Below it, NPV would be negative. For example, if I go up here and I change this to, let's say, $550,000, which is less than this break-even amount, 550,123, you will see going down here that NPV is now negative, and of course IRR of 7.6% is less than WACC, which is 10%. So undo and undo. So as it turns out, actually, you find that the break-even lease payment for the lessor of 592 and some change is actually less than that for the lessee, meaning that there is a negotiation room between these two parties, since for the lessee can afford to find this lease contract more cost effective if the amount is no more than $616,000 and change, while the lessor will find this lease deal to be of value if the lease payment is no less than $592,885. So the difference between this 592 and this 616 is the wiggle room that these two parties have. And as you can see, I believe that these two parties have a very good chance of locking in a deal. All right, so hope you understood this presentation and enjoyed it. If you need a little bit more clarification, watch it again. All right, thanks for being here. This is Pat Obi, Professor of Finance, Purdue University, Calumet.